Welcome to the Salty Investors episode number 18. I'm Tim. No, I'm not. I'm Scott. You're Tim, aren't you?
Yeah, so it's still, I think.
That's right. It's even got our names on the screen and I couldn't even figure that out. So, Tim, what is your salt this week?
Oh, just the Fed comes out and lifts rates. I thought, long dated maturities, stocks, they should decrease on that. You're thinking, oh, well, but now the market's sort of rallied again. It's like power's the new hero. We don't need free markets as long as we've got power backing us here. Everyone seems to be looking through now. Second half of the year, the pivot's on. The recession is going to be mild, if we're going to get a recession at all. Markets are roaring ahead now, and all this.
We've missed it.
Yep.
It's over. Pack up the podcast. We're done.
We've been wrong.
Stick a fork in us.
Yes. Fire us now. Take back all your money. Yeah. So just a bit salty about that. Thinking, wow.
Yeah.
Market's like losing its mind now. Things are just getting really out of hand here. So, what are you salty about this week?
I'm just salty about Meta because I think, entirely my fault. I'm not going to blame markets or sentiment or anything like that. We saw it happening in real time, and I bought into the narrative rather than just sort of sticking to the data, which was, and you'd said this, we'd both said this on the podcast, that Facebook is a cash cow. It wasn't spending all its money on Meta. It was pouring a lot of money into it, but it wasn't spending all its money there. They still had the cash generation business, and I got down to late 80s, in the 80s, I think. It's now closing in on 200, and I just think that's a lesson in listening to narratives rather than just sticking to the facts.
Yep. Yeah, it's still got a little bit of way to go, but I don't know. Yeah, but you get caught up in that sort of stuff, I think. But it's still got some headwinds. So,
Oh yeah.
Does everyone believe that Mark isn't going to go into Meta now, or is he speaking honestly to the market here, and he's really going to focus on the core or the family apps? I don't know. I have to wait and see.
But did you listen? What did he say? Did he sort of back away from Meta?
Yep.
Did he
backed away totally? He said,
totally.
Yep.
Like it's just a big mistake.
Yeah, and he's basically going to focus on the core family. And every third word was efficiency. Going to be looking at dollars and try to reallocate. And every capital spend was going to, in the future, add to the bottom line. He's like watching every dollar. There's hardly any words about, the metaverse at all. I don't even think metaverse came up. It's just a bit about the AI, which is fine. Everybody likes that. It just helps with the news feed and everything in the family of apps. But yeah, it was dropped like a dog. But we just got to see if the spending drops like a dog, like does it really, that free cash flow comes back into the equation here. So we'll have to wait and see.
Did anyone ask why hasn't been efficiency and getting a return on every dollar been a focus for the last 18 months? I mean, did he just discover this concept, or what's the story?
Well, he's a dictator over there at Facebook, and I think he just can do whatever he likes, really, and
So you were saying, look, I took a gamble, I threw some shit at the wall, and none of it stuck. So now we're going back to the knitting.
Yeah, well, like you can imagine hiring people, and when you give them stock-based compensation to people, and you say, oh, we don't want to hire you at $250,000 a year. We'll give you $100 a year in stock-based compensation, but the share price is falling through the floor. It's going to be hard to hire people. It's going to be like, that's really tough to do. Like people go, well, maybe I'll just leave and go to a ship that's actually, doing the right thing here. So there's a few factors going against him here. So, but Terry Smith held on. I've got to give it to him. The brother, he looked through all that and he'll read him and go, yeah, okay. So, yeah. But he said,
did he add to his position while it was down?
No, he didn't add one bit to it.
That's a mistake. That shows a lack of conviction, Tezza.
Yeah. But he threw Julian, because Julian is his offsider, threw him under the bus there a little bit and said, oh, yeah, Julian brought that to us. Like, he wasn't really he doesn't throw Julian under the bus really, but
Yeah.
he said, yeah, Julian said it was going to be a hard one to hold, and you can see why. It's not
Mm.
like the normal stuff that he holds, which is like these huge moats that, just really professionally run organizations.
Yeah.
Yeah, I don't know if he regrets it or he's looking to sell now. If it gets over 200, he might be
Mm.
thinking this, oh, well, lighten the load here a little bit. Because all this antitrust stuff and could be a recession on the horizon. Who knows, Like, that's not all
Yeah.
solved. So,
So, all right, that's a salt. Now, I don't have any slides about what the Fed did. It was pretty straightforward. There was an expectation that, well, some people said they'd go 50. Actually, I thought they'd go 50. They went 25. Powell became a little more dovish. Markets are happy, up and away. What have we missed, Tim? Are we wrong? Is the market getting ahead of itself? What do you think?
well, I agree with the market here partly. I believe
Mm.
inflation is going to come down. Like
Yeah.
the next couple of months, we're going to see some great headline numbers here.
Yep.
But will it get down to that two number and hold there? And
Yeah.
I don't believe, even if it does get to a two, Powell's going to pull out the thing and go, oh, we've got room to cut here now. Let's
Mm.
let's cut this. I don't think he will. I think he will just, wait until there's a full-on disaster before cutting. But like
No,
that's my
it doesn't
gamble.
make any sense to, because I mean, if you think about leading up to this period before we got to the inflation, we've had say 2% inflation with a solid economy,
Yep.
right? So and you didn't, but interest rates were already too low. So it's like, why cut if your unemployment rate's below 4%? I mean, what do you need? Why are you cutting? I mean, you're really asking for inflation to come back.
hmm
Um, so yeah, I think that's sort of the risk, isn't it? That people are anticipating rate cuts by the end of the year, both in the US and here in Australia. And if they don't get them, what does that do? I mean, Jamie Dimon came out and said cash is no longer trash, and he prefers it to bonds and equities. Well, he would say that, wouldn't he? It's good for his business, but yeah, I don't know. I keep, this reflects my own bias, but that people are still anchored to uh, elevated inflation economy where you just go back to, we can just buy stocks at 30 times earnings and not really worry about anything. And away we go. I'm just not sure that's the case. I mean, did you have anything? Well, actually, you know what I'll do? I will, because I'm going to go past this Australian mortgage stuff and go to the earnings of the big tech companies that came out today. Actually, well, they came out a few hours ago, our time. Apple missed. Amazon beat revenue. EPS missed. Alphabet missed. Ad revenue falls. Not a surprise. Not a big surprise in either of those. That was all expected. Maybe the Apple one. I don't know. Is this? See, with Apple, is it just a case of because we're not in an upgrade cycle, we're not in a new version of something coming out? I mean, is this just the normal sort of cycle for Apple? I don't
Oh,
know.
people, it's not 3-year cycle isn't
Mm,
happening anymore. The phones are
yeah,
getting too good. Like,
yeah,
how much faster do you need, unless you're playing games or something, why do you really need to be updating on 3 years?
yeah.
The cameras are getting better, but not that much better. Like, I don't know. And then they're losing share to Samsung in Australia. They're still
Yeah.
55% of the Australian market, but
Mm,
Samsung's at 28. So,
right.
but it's just that ecosystem.
Yeah.
For Apple, it's just they take a 30% clip on the first year and 15 every year after that. Like, that is just makes Visa and Mastercard look like chumps.
Chumps.
Yeah, compared to Apple. Like, Apple
Yeah.
really hits you 15%. Imagine taking that straight off the top. Like,
Yeah.
and you do nothing. You're just running a freaking electronic store with zero capex. Like,
Yeah.
oh. But I was an
Yeah.
idiot. We've talked about this before about this. So, like, so yeah, I don't know.
Well, I thought it was interesting that so yeah, all these results were after market, and you see Apple was about 150 before close, and then traded down,
Hmm.
and then traded straight back up again. Um, and actually, I took that snapshot about an hour and a half ago, and it has traded down to about 147, I think 148. But again, I mean, I guess I'm trying to tell myself a story that I'm not that wrong, which is that um, good news is good news and bad news is good news as far as tech, big cap tech is concerned. So people didn't really care that Apple missed.
Hmm.
Maybe it's what we said that, yeah, there's not that upgrade cycle. There's no new devices coming out, so big deal. Amazon's revenue was bang on, but their EPS was off. But that's not unusual for Amazon. Um,
Oh yeah.
and Alphabet was sort of, I don't know, it wasn't bad, and the drop in advertising revenue was expected. But I don't know, Tim. Maybe we've just overestimated this. We've missed the turning point, and we should just hang up the boots and call it a day.
Well, I'm just going back to your thing from weeks and weeks. You've been going about earnings. There
Mm.
hasn't been any really downgrade in earnings here yet. So, well,
But there has been, so I did see some early numbers on the number of beats and the number of misses,
okay.
and the number of beats was lower than the average, and the lower number of misses was the higher than average. Um,
Oh, yeah.
that's not by much. Like I think, okay, the average on average, 75% of companies beat, and
Okay.
that's because they play the game, right? You set a bar and you
Go
just
over 'em.
jump over it a little bit, and I think up to not doesn't include these results today. Up until last Friday, I think it was about a 69% beat rate. So it was less than average, and the miss rate was higher than average, but not devastating.
Yeah. Well,
So I mean, you'll probably see, you know, on the back of these, you might see some downgrades on these
mhm.
earnings. Not a lot, I wouldn't expect, but some. Um, so yeah, maybe the consumer is just resilient. They just don't care. They blew through all that excess cash. They're just going to rack it up on credit cards now. Why not?
Yeah. Happy days. Well, it's good for me.
Yeah,
Bitcoin holder here. I'm feeling like $1 million. But
yeah,
just just seems a bit delusional. That's all. Yeah, I don't really believe it. So, well, I could be wrong. We'll have to wait and see.
yeah.
So,
Yep.
capitulation hasn't happened yet. So, yeah.
No. Yeah. I mean, this happens in bear markets, especially prolonged ones. You get nice chunky rallies. Everybody think it's all clear, and then down you go again. Um, we shall see. So I'll just go back. I think it was worth looking at. This was a Roy Morgan piece. It came out 27th of January. It's about mortgage stress. 24% of mortgage holders are now at risk. So if you look at that graph on the left, that refers to the grey
Okay.
part of the chart. Now, if you have a look at that, it doesn't look particularly high
Hmm.
historically. So it's just sort of poked above the last. It's higher than it's been in the last 10 years. So if you look across here, but if you go back to about 2013, then that's about where it was before. So it doesn't look that bad at this point. But I mean, this is obviously all the interest rate
Hmm.
increases have not taken hold,
Yep.
and we've probably got more interest rate rises to come. I think at least another one, probably two.
Hmm.
Deutsche Bank, as we saw earlier in the week, have gone ape shit, and they think that they were they were at a 3.1 terminal rate. Now they're at 4.1, which is pretty crazy.
Hmm.
That's what they're thinking. They're not the only ones there. There's somebody else there as well. And just that other chart on the right hand side there. So about what have we got there? Oh yeah, so that actually shows you the number of mortgage risks at different levels of interest rate increases. So right now, that one on the left, that's that 23.9% figure, or
Okay.
1.1 million. That's interest rates at 3.1%. And remember, they haven't all flowed through yet because there's a couple of months lag for every interest rate rise. So then if you're 3.6, you're looking at 26.3%, which would get you back up sort of in this range. Still not, it's not terrible, not something we haven't seen before. And but if you get to 4.1, then you're probably going to be up here, sort of GFC levels. If that's the case, I don't know. I don't know about you. I don't see that. So this I picked this up from Macro Business about Deutsche Bank. Philip O'Donoghue. He actually, sorry. So he said it would peak at 3.35 before, and now he's saying 4.1. So he sees rate rises in Feb, March, May, and August.
Wow.
I mean, that's pretty crazy stuff. And that would mean discount variable mortgage rate would be about 7.5%. And you've got people refining out of 2.5% mortgages, 7.5% mortgages, and as they said over here, that's a 56% increase. Sorry, 3.5 to 7.5. So 56% increase in your monthly mortgage repayments on 500 grand. It's $1,250 on $1 million. It's $2.5 grand to your mortgage repayment. I mean, and look, if you've got a household income, a couple of professionals, and 350 grand household income, you're fine. You're fine. But that could put some stress on you if you got an income, even if it's a household income of 175. That's going to sting, isn't it? 2.5 grand going out the.
What happens if you got 3 investment properties, even if you are 2 professionals? And then Airbnb has a bit of a slowdown here. No one really wants to spend that sort of $300 a night in an Airbnb. I don't know. Might be a little bit tough even for the dual professionals here. So I don't know. I'll have to wait and see. It just seems 7. This seems insane. I just can't see that ever happening. Like, if it does happen, we'll be stuck with it for 2 months or something, and then, things will crash real quickly, I think. But I think the panic will just take over even before something serious happens. I don't know. What do you think? You think we could handle 7?
I mean, I'm been beating the same drum for 6 months, saying that I don't think we can handle interest rates that high in Australia because of how high our mortgage household debt is. Just be too tough. It'd create too much weakness, too much instability. I mean, see that last line down there. The situation would be made worse by the fact that nearly 1/4 of Australian mortgage holders by value will this year switch from ultra cheap fixed rates of around 2.25 that are double or triple this level. That's So I mean, you thought you were a genius. You locked in 2.25 a couple of years ago, and you were, quite frankly, it was a good decision. But
there's still 30-year mortgages, but even if you locked in 2 years, still
Well, see, in Australia, you can't lock in a fix for more than 5 years, and even doing that, you have to pay up to do it. You have to pay a higher rate, so it's not.
So no one does it.
No one does it. People lock in for 2 or 3 years max. My view on this is, Tim, is I don't think this has to create the economy necessarily, but what does it do to discretionary retail, which, as we've been saying since the beginning of the year, has just had this wonderful 20-30% bounce, depending on the stock you're looking at, sometimes more than that. I think Adairs is now up 40% or so from it's around 290.
You should be switching to the trader. Stop this investing garbage. Start trading some of this stuff.
At least I have exposure to that, but I feel like well, it'd be very interesting next month because we'll get half-yearly reports, and I'm sure all these retailers will say that they had nice Christmas periods and good first half results. But the commentary, it'll be all about what they see, going forward. Because they will, all the retailers will give you their first 6 weeks of January, the first 4 weeks of January and the first 2 weeks of February sort of update. They'll tell you that.
Okay.
and that's what they usually do. That'll be interesting to see the commentary because I mean, if they say, "Look, we don't see any problem, the regime is holding up," I've got to go. All right. Otherwise, I'm inclined to. I'm really close to just cutting my Adair's exposure in half at this point.
Take the cash. Have you seen your home builder,
Yeah.
Horton? It's like
No, what's it
5%,
done?
5% of its all-time highs.
Ah,
Home builders are
yeah.
the new thing. Like it's just rallied really hard into this year. So
Maybe I'm
yeah,
just old. I'm just behind the ball. I'm consistently behind the eight ball. Yeah, because I would have thought the discretionary retail bounce will come once we get the all clear, but nah, it's already run. Big tech's already run. Home builders don't care what's happening
yeah,
with the housing market. Uh, you know, gee, I'm just too old.
yep.
Like, I don't get it.
You
Um,
need to block your mind out. 10 years. That's all you need. 10 years of knowledge,
anyway,
and yeah, be
yeah.
fine.
Anyway, let's go to the stock of the week. Adani, which had a nasty little report come out about it.
Yeah.
Um,
So back onto the trading thing. I was looking at this. After the report came out, it went
mm,
down a whole 3.5%. And I'm like, wow, this is a pretty nasty report. And I
mm,
can't, I knew they were just going to fluff over it. But now you look at it, it's 59% down. Like, what am I doing here? Shouldn't I be shorting
wow.
this stuff? Like, but trader, but as you can see, just took so long. The market doesn't react as quick as you think.
Yeah,
Like,
that's unusual, isn't it? It's unusual. So people, what, they didn't believe it to begin with, or
yeah.
took a while to digest? It was a big report, I suppose. Took a while to read it.
And there's a lot of big and it's illiquid. And so the
Yeah.
holders of it are basically their other companies. Like, Adani hold it. Like, and there's only like small people. Like I saw a couple of guys buying the IPO, whatever they call it, and he bought like 4 shares of it. Like $150 worth. Like there doesn't seem to be huge Western institutional holders of this, and you can't
Mm.
blind short sell this. Surely you'd have to be a freaking lunatic. But like you're just seeing some of these things, and I'm just hoping this causes a little bit of a problem to the
Yeah.
India ETF here because I want to buy it. Like because I'm thinking 20, 30 years out. Yeah, it'd be quite good. So yeah, that's all. I just wanted to say some of the things that are happening. That's all.
Yeah.
This one, you might
What do
remember
we got here?
Chris Holm and
Yep.
old mate of the channel here. Bill Ackman. They own this.
Yep.
They own the equity portion of it.
Hmm.
And Perpetual. You don't see these things anymore. These bonds that last forever. Like holy hell. Like, and it's at 4.7%. And this is going to go for another 100 years. Like, I can't
Wow.
see, flying trains happening. Like, like this is, and so my question is we hit a bit of a rough patch here. Do you grab any bonds? Like, you
Mm.
know, I know no one's talked about bonds for freaking a decade or a couple of decades.
Hey, is that Egan Jones rating the triple B plus? Is that who that is?
I'm not
Egan.
sure. I don't know. Is it? Who is?
So
Who are
Egan,
they?
during the financial crisis, when Moody's and S&P and all the rest of them just turned out to be complete frauds
Hmm.
that were rating mortgage-backed securities AAA that weren't AAA, Egan was there, and they were calling this shit out because their model is that the investor pays them to get a rating, not
Yeah.
the issuer.
Okay.
That's so. I think I don't know if the EJR is them, but I hope
Probably
it
is.
is.
Yeah.
Yeah,
So is the composite there? Is that all three, or is it just Moody's and S&P for the? It looks like it's only Moody's and S&P
maybe it's
to
just
get
Moody's
up.
and S&P. I don't know how those people have any credibility anymore. I
But
suppose
as you
they're
can,
the only ones around that had the infrastructure to do it.
but you can see it's
Yeah.
a moat here. This is the Bloomberg terminal, and you can see
Mm.
they're not going to add more people to the frickin' terminal here. You either got to. If imagine you didn't have Moody's or S&P, who's going to buy this bond? Imagine you didn't have that rating there. You can see why it's so
Mm.
strong. This moat for S&P and Moody's.
Yeah,
So
yeah.
I don't know, but yeah,
So
like
what do you reckon? So yeah, I mean, look, grab some yield. It's nearly 5%. Why not? Um,
yeah. So if it crashes, we hit a crash here. do you grab the equity, but still a capital intensive industry here, like,
Yeah.
and that's what Chris Holm and, Ackman, they like it because it's like a fickin' moat here. There's no one going to go put in railway tracks next to this thing. So I thought, oh, maybe if it got up to an 8, would you be happy holding on to an 8% return coupon for eternity? Would you be happy with that?
I would be. I would. I think what you should do is reach out to Howard Marks and ask him, because I would take his word for it before I'd take mine.
Yeah.
The guy. He's the guy to ask.
But we don't talk about this stuff anymore. No one does. Like,
no, because it's boring. But boring can be good, especially in a time like this. My question is: you said there's a lot of capex. Is it? Because I'm thinking, how many more new railways more tracks are they laying? Is it mostly maintenance capex? Is that what it is? Yeah. Just upgrading and
Yeah, and it's continual because it's out in the weather, and the things just get bashed around. It obviously gets used, so it's valuable.
Oh yeah.
So it's not like it's not getting used, but yeah, there's the capex to get labourers out, putting out tracks. You can imagine what that's like.
Yeah.
So
especially in a Canadian winter.
yeah. So, but yeah, there's a huge moat there. Like, I'm just thinking, maybe I am getting greedy, because I remember Buffett saying, in the 80s, why no one was in equities? Well, you could, sitting on these
get bonds. Yeah.
It wasn't
15%.
delusional. Yeah.
Yeah. Well, who wouldn't get paid 15% into perpetuity?
Yeah.
Ridiculous.
And he said, he should have probably been buying more of that. Don't worry about the equity game so much. You should be balance this out a little bit. So yeah, that's all I thought. Just interesting. Bring something a bit crazy.
Oh, it's not crazy.
1922, mate. Like, been this crap's been 1922.
So these bonds were issued in 1972. Is that right? Is that what we're looking at down there?
Yeah, but to see on the bottom there, it's like, I think they must have reissued it or something.
Serially 1921-28. Originally issued 1922.
Yeah,
Jesus.
So, like, you'd be putting this in your will. This is the sort of...
Yeah.
But I'm just saying, we get a chance here. If this thing pops up to 15%, you shouldn't be getting super, super greedy. You should be picking something... I know you can just pick, government stuff, but, I want something just productive. Who knows if the USD is going to, keep going forever, but I've pretty much faith that these guys will keep trugging along. So, yeah.
Yeah, no, that's a good find. I'm a bit neglectful of looking at the bonds, right? Just and there have been, I don't know if you've noticed, but a few places through Livewire Markets and other places getting advertisements for bond funds opening up, advertising 8% yields and all this sort of stuff.
Yeah.
That's the type of environment. Are we at the end?
No.
What do we got here? Novo. Oh, it's a Swiss, is it? Novo Nordisk. Yeah. Oh, yeah, I know these guys. Yeah.
So they make this diabetes drugs. That's what they're well known for. They've got a couple other things in the works as well. Like it, if you look at these numbers, it's just insane. Like return on the invested capital, like you got 80s. Oh, it's dropped down to 60s. Like absolutely insane. It gets cut in half.
Gross margin 84. Operating 44. That's amazing. Yeah.
And they've been doing it for a long time. And you look at the price to free cash flow. It's 12.
Yep.
So, okay, so it's insanely cheap, but, it's expensive. Like, it's just been on a tear forever. Why?
Right.
Well, they've got this diabetes drug that, that works really well, but now they're selling it to overweight people. And it's going really well. The CEO gave us a few numbers. There's 109 million people in the US that got a BMI above 30.
Yep.
So this is the thing, when you've got these high return on invested capital, you can't just look at that. You've got to look at what's the reinvestment here. Can they grow their revenue and obviously put money into things, manufacturing or creating product, cost of goods sold, and then burn it back out into cash for us.
So what explains the growth? They just haven't had much in the way of, like, do they pay most out in dividends, most of their earnings? Is that what they're doing? They're
50%
not
of it.
reinvest 50%. That's it's
You
not
can see
that bad.
they're doing buybacks here as well a little bit. So they're buying back a little bit of it. But yeah, it's just insanely. But I'm looking out 5 years.
Yeah.
There's Eli Lilly, they've got a similar type drug. So they're going to, but you can see this market is huge. So
Yeah.
the reinvestment rate is going to be great with super high returns on invested capital. The problem is I put in my DCF and it's
Yep.
twice as much as what it should be. And if you put it in yours, it'll be like 3 or 4 times as much as it should be.
Well,
So
what are you using for a discount rate now these days, or a required return? What are you using?
10%, but I'm
10.
and I'm using not free cash flow growth. I'm using revenue growth as my
Right.
growth. To be a little to soup a bit more like the kids are doing nowadays. And I still can't get there. So I'm like, oh, it's so. This is probably the best company in the world. I would say that now. This is with the amount of runway
Mm.
they've got to reinvest. I can't see any company in the world beating them. Like, this is going to be mammoth in 5 years' time because you've got the Kardashians now taking this stuff or recommending it.
Jesus Christ.
And you think, so yeah, and the US insurers, they've now accepted it to
Yep.
be used for obesity. So that means you're not paying, because now there's people who pay 80 to $100 a week out of hand, just
Out of
cash,
pocket. Yeah.
yep, to pay for this stuff.
Yeah.
That's how strong, and they can't keep up supply. They just can't. They're not even opening in the UK. They go, oh, we can't supply it. Like, we cannot. Like,
Well, that's a good problem to have. All right. I'm gonna do my own valuation on this now that you've brought it up, and let's revisit that next week. Anyway, thanks for listening, everybody, and we will see you next time.